forward and we'll talk a bit while we give people time to roll in. But regarding what you were saying earlier about the numbers not recovering, I was reading an article earlier this week about from the ex-CEO of McDonald's was saying something related to that. Basically, the workforce is decreasing, people are dying, some people are retiring early and they're not coming back. And he's ringing the alarm bells. Or what are your thoughts on that? Or are you going to cover that later?
No, that's true. And it's interesting. We will cover that. And one of the things that is noted, if we look at, say, the 3.6 million, give or take, Americans that were out of the labor force between November 2019 and November 2021, roughly 90% of that number can be explained by people age 55 plus. And then likewise, on the other end of the equation, we're seeing slightly more employed people in the 16 to 24 age bracket. So not necessarily always the McDonald's cohort, but where we're seeing kind of a greater return to the labor force in that area, but it's not enough to make up for the losses. So we have this huge, exodus of early retirees, and this is putting pressure on a lot of things. And also, I think the little unheralded part of this is we have very low population growth. We have the lowest population growth between 2020 and 2021 we've recorded as a percentage, just 0.1%. And if you think about this, of course, it's due to the pandemic, greater mortality, terrible things like this, but also lower immigration and lower natural increase. And that combined together reduces sort of the power of the labor force and helps invert that population pyramid to where we might see some greater difficulties down the line. And I think that, we overlook the fact of how much we are very much an immigrant nation and how many we rely on labor from other countries as well. So it's a really interesting thing. And when you shut off that spigot, you end up with issues. You end up with a lot of issues involving the way that people engage and the way that we have job availability, as well as different weird sector and wage oriented issues. So I hear the former McDonald's CEO's point on this, but, and it's true, retirees are big, but of a story of hope for him is, or them, is that we're experiencing slightly greater growth in the labor force among younger people as those wages come up. And that is encouraging because we've seen kind of like a 3-decade decline in that particular category. But it's like a drop in the bucket relative to the number of people who are retiring.
Okay. There's a lot to dig into on that. I'm looking for this closed captioning thing.
Ooh.
I just activated it on my side. I actually don't know if it's available for us until we actually start it. So whoever asked, one way you could actually get around this is by going to our Facebook page, and Facebook will automatically transcribe this too. So I'm going to go ahead and drop the Facebook link in there. And so if you join the community right now, because I believe the video is live in there, I will go ahead and let you in, and you can go ahead and figure stuff out as you go from there.
Okay.
Cool.
Well then, let's kick this off. Welcome to our December 2022. It's going to feel weird saying that for a while. Jobs report and start of the year recap. We hope you are safe wherever you are now that Omicron numbers are very, very high. Today, we're going to recap the December jobs report, which showed an increase of, I don't have the number immediately.
199,000.
Yeah, 199,000 jobs. We're going to recap how December went, which seemed to be confusing because people were expecting certain things and they weren't really being met. But we'll let Dr. White talk about that. Today with us is Dr. White, an associate professor of finance and endowed Bank of America lecturer at the University of New Mexico. In addition to teaching MBA students, he also serves as the University Outreach Chair for the CFA Society of New Mexico, chair of the Cassidy CFA Scholarship, and advisor for the 3.6 million student-run UNM Regents portfolio. Prior to his career in academia, he has also worked as an analyst for a large Boston-based bank, where he learned a great deal about company analysis, funding, and maintaining ethical corporate leadership. As a note, this call will be recorded and made available within 7 business days. And feel free to drop any questions you have into our Q&A section below. So now over to you, Dr. White.
Thank you so much, Colin. Thank you so much to Albert's list, to Albert and in the list. Thank you all for joining us on this magnificent Friday evening to discuss a very mediocre but mixed bag of job report that we have in front of us today. And it's very exciting because we can talk about a few big pictures. And we got some other data out that suggests that, well, we have a little bit more information about the participation rate, other things, what to expect as we sort of climb out of the recession we had last year, and what not to expect at the same time. We're going to go over a little bit of details and kind of finish up with a little bit kind of our retouching on the California exodus and what's happening there in the nature of that story in a brief sense, and what we can expect. All right, so I'm going to share my screen here to show you, for those people in the cheap seats here, our December 2021 jobs report. Let me grab this here so I can share it. Sharing on Zoom is caring on Zoom. So December 2021 jobs report. So let's talk about this. A tale of two surveys. We were expecting, ADP survey came out the other day. We had made over 800,000 jobs. So kind of people were crossing their fingers saying, my goodness, we're also going to hit this level again. As it turns out, we hit 199,000, which is not even a particularly good jobs report in a good time in terms of the physical number of jobs created, but let's dig deeper into what those numbers means. Okay, so the payroll survey, so this is interesting. So the payroll survey looked at the number of new jobs, we had 199,000, but here's the other thing, the household survey, when it actually asked people, are you in the labor force? Are you looking for a job but do not have one? That unemployment rate dropped to 3.9%, 3.9%. Back in the ancient days as when I was a student of economics in the ancient days, we used to call numbers below 5% really close to full employment if they aren't full employment. 3.9% is a very low number historically. It is a historically incredibly low number. But again, what to calculate that unemployment rate, and this is U3, you take the number of people that are in the labor force looking for work divided by the total size of the labor that can't find jobs divided by the total size of the labor force. The thing is, to be included in the labor force, you have to be out there looking for a job. So if you quit and weren't registered anywhere, you're not part of this survey, you're not a thing, you're doing living a lifelong dream somewhere else, you're not included here. One note about this is that when we think about the payroll survey, we're polling a whole bunch of employers and asking, how many new jobs did you add, et cetera, et cetera. What this tends to overlook are people who may have started their own business or been entrepreneurs, and in which case they'll pick you up in that household survey because you're working for yourself, you have your own job, and you're not looking for work, and so you're employed. And this wouldn't be picked up necessarily in the payroll survey in the same way. So there's a discrepancy in the way that they measure and evaluate things, which is really important to note. Now, where do those new jobs come from? It was a motley of places. So first of all, we gained jobs. Yay, it's a small positive. And we had about 53,000 in leisure and hospitality, 26,000 in manufacturing, and about 22,000 in construction. And this is really interesting. Construction usually has this die down period as we enter the winter months. This is kind of exciting to see a little bit of a pickup there. Obviously, we're seeing a lot of gusto around continued high real estate prices around the country. 26K in manufacturing is also really interesting as well. So those are all relatively good signs. But again, these are much smaller numbers than what we expected. Another story of hope, upward revisions in October, 102,000 in October, 39,000 in November. That means when the Bureau of Labor Statistics went back and looked at those numbers once new information came in, they were able to upgrade the amount of jobs that were made in each of those months. And those were all both positive. Sometimes they upgrade them, sometimes they downgrade them. Upgrading means, hey, guess what? The economy was doing better than we thought it was. Yay. So that's the good news. Now, so I know this is a little bit more, hold on, this is more positive than this, because in the back of my head, read this like you're an economist or a finance person, you're looking at this, or let's say you're working for the Federal Reserve and you're looking for a key. You know inflation is high. The year-on-year inflation at 6.8% last month. We're going to get a new number in another week. Annualized at 6.8% is historically the highest we've seen in 40 years. This is a very, very high number. So to what the Federal Reserve has to decide is whether or not they have to raise rates. And the Federal Reserve, again, for those of you, I know some of you are regulars and you've heard this over and over again, the Federal Reserve determines the overnight lending to large banks called the discount rate. When they increase that rate, what that does is it makes it harder. What it does is it increases the discount rate. It increases the cost of capital for banks, and they pass that on to smaller banks. It increases the discount rate and decreases the net present value for new activities that are happening, new economic activities. So it kind of turns the spigot off of economic growth. And the reason you would like to do that is that you want to control or limit the monetary supply growth so that you can limit inflation in a positive way. So by raising rates, they can lower inflation. By lowering rates, they stimulate economic activity and can get us up to those levels. And we've had rates very close. That target is between 0 and 0.25% now for quite a bit of time. And they're expected now. And right now, looking at this jobs report, the real question is it bad enough for the Fed to say, wait a second, we can't raise rates to respond to inflation? And I contend it is not because of the nature of these other positive characteristics. The other thing is, and so when we think about the rate hikes in general, the market is pricing in on average where we know that the market expects 3 rate hikes next year of about 0.25% each time. There's about a 50% chance that the discount rate in a year from now will be around 1% or not 1%. And I look forward to this. Maybe we can come back to this later and see if we're actually right. Who knows what 2022 will hold? Is it worse or better than 2021? Who knows these things? So the other thing that happened, which is a little bit higher, which was interesting because it was higher than expected, wage growth. Hourly earnings rose to $31.31 per hour. That was up about 19 cents and about 4.7% year on year. This was a greater number than expected. And it shows that the wage growth is accelerating across the economy. This is very interesting. It is good news and bad news. It is good news because on one hand, you need to make more money to pay for the goods that inflation makes more expensive. And to Albert's point, it is not higher than inflation right at this particular moment in time. And so consequently, if wages don't meet inflation, you're losing money, but at a slightly lessened clip. Now, on the other end of that question, you have the aspect that inflation can be self-fulfilling. It can last for a long. Inflation is a very interesting beast, and it's hard to control. And we haven't seen it since the 70s and 80s. And policy experts at that time, we have all kinds of views about. We have a good sense, more or less, of what happened and the nature of what happened to keep inflation high for so long. And then starting in the 80s, we embarked upon a very, really the modern sense of how we viewed monetary policy and the role of the Federal Reserve. And this has since evolved even further in the last 10 years. But the big picture is that our hourly earnings in general, wage growth powers inflation in the long run. The more money that people are paid, the more likely it is that employers will continually charge money for goods. And it becomes this weird cycle. We'll pay you more, but we're going to pass that on to you with the additional price of products and services. And so this is why I think, looking at this number in particular, the Federal Reserve will look at this and say, listen, it's unlikely in the January meeting they'll raise rates. In March, it's I would say fairly likely. I would be surprised if they did not raise rates in March. So Albert says, Colin and I were talking earlier this week about stagflation, a concern about its emergence in 2022. Will you talk about that today too? Yes, we can talk about stagflation. So stagflation, the combination, the chimera, if you will, of stagnation and inflation, where you have prices going up, but economic growth remaining steady. Oh yeah, Albert, they're going to be ambitious about this year a little bit. And I think, but there's a couple of things about this. So stagflation is interesting. So right now, we're still expecting GDP growth to be relatively high, give or take 4.5%, maybe 3.5% if things go adversely for various COVID variants this year. Those are good GDP numbers, and that's growth. So a stagnant economy a stagnant economy, particular one with low population growth that we'll get into soon. To be truly stagnant, we'd have to see GDP growth slow down in a meaningful way, and we haven't seen that yet. What we're seeing is symptomatic of a very a strong but unequal economy, and inflation is symptomatic more of overheating rather than not. But that being said, let's think about the situation that would lead there. To result in stagflation in that traditional sense, inflation happening, but you have prices still rising. You have to end up with the way that supply and demand works across the economy. Right now, demand is very robust. Retail sales are very good. Consumer sales are very good. People are going out and spending money on things. And if people stop spending money on things, you would then see an issue where, oh my goodness, we're stuck with, say, transitionally high wages that we can't lower in an easy way. And we can't make up for it in other ways. We're going to increase the price of our products and goods. If that cycle happens where producers have to increase the price of goods and consequently people stop spending money to buy those goods, then that could be a problem. But we don't see a sign of stagflation yet. Inflation in the intermediate term will be interesting. And I really want to see how the market responds to the next particular couple months. I'm sorry, the first rate hike potentially in March, as well as ones subsequently middle of the year and then towards fall. And I'll show you, actually, there's a link. Let me grab, I sent this to one of our municipal finance managers today, and I want to grab it just for a second and I'll put it in the chat. I'll put it in the chat window so y'all can see it. So you guys can see it here. Let's see, there's just so many things, and this reminded me about this. So if you're interested in betting on Fed rates, if you have like an interest in this, you can go to this sort of website here. Let's see, I'll send this to everyone. CME Group has this little thing called Countdown to the Federal Open Market Committee meeting. And it does this thing. They have a countdown to a meeting. I feel like that's the level, that's a certain level. I don't normally see that level of meeting-based narcissism outside of academia, but it's very, very interesting. 18 days, 17 hours, 41 minutes until the next Federal Open Market Committee meeting. And what they do there, as you can see, they have this tool called the Fed Watch tool, which incorporates a bunch of economic and opinion-based variables as to whether or not they're going to raise rates. And so far, the odds are 92% chance in January that they will not. But if you click on that Mars portion in this thing, Mars, where is this? What planet am I on? Hold on. Maybe I can grab this. You can see the, I'll see if I can share my screen for, I'll change windows here and I'll show you. We'll do a little live finance. Let's see. Here we go. So here's what we got. So our target rate, if we look for our 16th of March, 2022 Federal Reserve meeting, there's about a 71% chance they're going to raise that rate to 25 to 50 basis points. 22% chance they'll keep it low. I'd be surprised. Like the pressure that they're under to increase is pretty high now. And then in May, that number is expected to be 54%, and they're looking at other potential increases. You can go meeting after meeting after meeting. They meet every month and a half or so. We're looking at 2 rate increases by June. And then if we go back to the end of the year in December, we're anticipating maybe that the target price right there or the rate prices will there. And this has been updated today. We might even see 3, possibly 4 increases next year. We're going to see what happens. And this is really interesting. And the market responds interestingly to this. And if I look at this, let's look at this. I'll bring up something called the Federal Reserve interest rates. This is the H15. And the H15 are all the daily interest rates. So when the government spends more money than it has, which is often, indeed, every year that we've seen, apart from 1 year back in the 90s when we actually had a budget surplus, to raise extra money, we issue bonds. And many people buy bonds. Other countries, we buy our own bonds. They're in your retirement plans and your portfolios and things. And everybody has bonds. So we all own the debt of the United States. So your 401ks, other things and everything as well. And so what we can do here is we can actually look at what's called the yield curve. And the yield curve is kind of a line that connects the dots between the rates for certain government debt. if you're taking out a very short loan if the government's taking out a very short loan, like a 1-month bond, they're going to get away with, and again, these are all annual interest rates, about a 0.04% interest rate. And then the 1-year rates are about 0.45%. This is really low. So if you bought a 1-year government bond, you could receive 0.45% a year, just rolling in the pennies with that type of interest level return. And then your 10 years, 1.73%, and your 30 years, 2.09. So normally the yield curve is upwardly sloping, which makes sense because the longer we tie our money up for, the greater we want to be compensated for uncertainties and risk. So consequently, we're going to want those higher rates. And what this is, and here's what we have to watch for, and this is of note to the stagflation question. So right now, the Fed raises rates, and this will increase all those short-term rates. So if the Fed raises rates 1% this year, let's say, that's going to raise all those short-term rates close to 1% or a little bit higher. The question is what those long-term rates do. Like after today's jobs report, the yield curve got a little steeper. That's good because it predicts continued robust economic growth. When the yield curve flattens, rolling in the pennies, Marta, good reference. When we see when the yield curve kind of bends like this, so what happens is that the Fed raises rates. Imagine the short-term rates are my elbow and the long-term rates are the tips of my fingers. What's going to happen is the short-term rates do this. Sometimes this happens and the yield curve becomes flatter. And when the yield curve becomes flatter, that can often lead to recessions. And that's what happened right before the financial crisis of 2008, is the Federal Reserve raised rates significantly in a year that flipped the yield curve like this. And we were looking at a flat yield curve. Now, it doesn't mean a recession happens immediately. If you look at Campbell Harvey, his a very famous and much more competent finance professor, back in the 1980s, he wrote his PhD thesis on the yield curve. And he said that, guess what? Every time the yield curve goes like this, every time it flattens, that means that the recession is coming, and it happens every single time. And it has happened every time. 2019, nobody knew there was going to be a pandemic in 2019. I didn't know, nobody, we're just like, something's going to happen. The yield curve was inverted in 2019. And just remember that 2019 yield curve predicted the 2020 recession because finance knows all. And it's also very mysterious. And that's why we have a lot of people who are like, is this a cabal of people who, is this part of the, there's a lot of conspiracy theory around that. But the long story short is that markets tend to, even when they don't know why the market will crash, they tend to predict those crashes pretty well. And so when you look at this and you see the yield curve do this, be a little bit careful with your investments overall and talk to your financial advisor about how to move it potentially in safer places than you might otherwise have, because it means a recession is coming. But that said, is that we're hopeful that the other thing could happen is the market responds well to the Fed increasing rates. They're like, we're going to control inflation. And what's going to happen is then the yield curve kind of does this. Boop, it kind of goes up one, and it's still steep and it's still upwardly sloping, but the long-term rates raise up to like 3% in response. We're going to see what happens here. And so basically you're going to be worried if this flattens out a bit, but right now we have some good news, at least a little bit, that the yield curve got a little bit steeper today. So Albert says, in your opinion, is the aggressive approach to raising rates this year going to lead to a recession? My goodness. Okay. If at 3 or 4 increases in a year, that's still mild. It gets really interesting if we look at, and here, let me find this real quick before I go back there. Let's go back to the, I have a graphic for this. Maybe I can.
I have a follow-up question as well.
Oh, yes. Yeah, Colin, while I find this, yes.
Okay, earlier when you said, in general, raising wages means higher prices.
Yes.
Is the inverse true?
Will lowering wages reduce prices? That's a good question. Is that a dog or which are we talking about, the dog or the tail? That's a really good question. So the idea is that so, and this is a very important thing as well. And I love that question, Colin, because you're looking at the causality of situations and looking at what's actually happening. So in this case, so imagine, so the reason is this current inflation isn't caused ipso facto by people being paid more, but what can power long-term inflation versus short-term inflation is wages. And so if you increase wages, in the long run that can increase the likelihood of greater long-term inflation. Likewise, though, the other thing is that if wages drop and you end up in a deflationary environment, and the only places we see wages drop in a meaningful way occur during some type of economic crisis. If wages drop, that's a terrible thing. And often it's also compounded with deflation. So that's a very, very interesting phenomenon. And that's, so it could be, and usually in that case, then it becomes symptomatic of something, a severe issue that's happening with the economy. And let me, let's see, one thing here. Let's see if I still have my Y charts subscription.
I guess I'm asking because
Yes.
minimum wage hasn't changed since 2009, and we've seen quite the inflation since 2009.
Yes,
So-
minimum wage hasn't. The average wage, though, has.
Mhm.
And that's the hard part. And that's the other question we talk about in economics. How many people end up are being paid the actual minimum wage? And it's a very surprising number. And there's a lot of people who are being paid the minimum wage. Many people are also paid slightly above the minimum wage, but still insufficiently. Here, let me share the yield curve here for you as well. So regarding that, so increases in that wage itself does affect people, and there is data to show that. And I can grab that data. Oh, good. 2022 job market. Jake. Yes, Christine, I'm going to get into the job market in the Bay Area. We're going to get down and I'll show you precisely where we're seeing growth and where we're seeing sources of stagnation. And I'll talk about that in a second, Christine. This is a great question. And so what we have, and so going back to yield curves, then I want to address the job questions as well. So the yield curve right now, so if we went back to 2020, January 2020, now again, this is before, if you remember, this is technically the before times. So that's before we knew that everything was a crisis. Before we really knew or really were exposed to COVID, we went out and we did things, and there was people, and there was these things, and we felt reasonable. I don't know. We felt safer in a different way. Maybe we didn't. But one thing is that we have this kind of flat yield curve, and that flat yield curve is inverted. Those high short-term rates and lower midterm rates was an inverted yield curve. And then we had a recession literally 2 months later. And then in this hand, what we saw back last year in 2021 was a very steep yield curve, anticipating strong economic growth built by the stimulus. That yield curve has remained steep, but it's kind of topped out at the upward end. And so what we're going to watch out is see what happens as these short-term rates increase. Will this flatten out so it looks like 2020, or will it continue to be upwardly sloping? So that's the big question. That is the name of the game. And that's something you have to watch out for, especially next year. Now let's talk back to jobs. And Christine's like, let's get on tell me what I gotta know about the Bay Area. So participation holds steady about 61.9%. I get off on asides. This is what I do. I do this in classes. We end up, I don't know, what are we teaching? I don't know. You just talked about macroeconomics for 6 months. Employment change in industry and confidence intervals. Long story short is that we're still seeing jobs coming back to the same industries that we saw in the last few months, but just fewer of them. So let's talk about this, because we're going to go high, and then we're going to drill down into the Bay Area. So let's talk about riding this wave. And so what we've seen, when COVID goes up, jobs go down. When COVID goes down, jobs goes up. That is the most simplistic explanation of the last year and a half in jobs numbers I can give you. So right now, people are like, this jobs report's disappointing. And I'm like, we have record numbers of COVID cases. It's going to be disappointing. If I follow the correlation between these two numbers, we did this a couple months ago, it ends up being a very significant, it's quite predictive. But long story short is that we have this situation right now where it seems we had this big bounce last July of new jobs coming back, another bounce this July, an increase in COVID in winter. We're looking at this way, but still in the big context of things, in 2021, we added 6.1 million jobs. That was the highest since 1940. Aside, we lost in 2020 more jobs than we ever had in any given year. So it was the worst of times and the best of times. Don't know.
We lost almost about 9 million jobs.
Yes.
Jesus.
And then we got them back.
Well, we got.
And this is 2020. We actually were down more than this earlier in that year. This is how we netted with regard to this. This is by the end of the year, we were still down 9, but we made back 6.4. Hey, yay. It's like a very silent, it's like a single golf clap in the distance. Someone in Santa Rosa is clapping. All right, so now age groups that account for 3.6 million of unemployed Americans who left the labor force. And this is really interesting. One of the aspects you're seeing in the job market is you're seeing an issue with regards to some sectors in particular who often struggled even before the pandemic to find workers, ended up with even greater distress following the pandemic. Now, of the 3.6 million people who left the labor force, until I started looking at this data and looking at other economic materials that just recently came out, I was still hopeful that perhaps half of those jobs might come back as we opened up a little bit and got schools together, those kind of things, working parents staying home, elder care. But indeed, it seems that most of the people who have left the labor force with regards to this account are over the age of 55. And then if we look at people of primary working age, we're seeing a little bit of a boost there, and then a continued sort of decline. And I misreported this. It's actually declining. So this decline is actually a good thing. It means more people are in the workforce than were out of the workforce. So we saw people leaving the workforce for childcare and elder care, mainly in the 25 to 54 slot. And then more people added to the workforce at the younger end as some of those wages came up, but not enough to make up for what's actually needed. And Martha says, oh, this is really good. So restaurant workers, $2 something with tips. Minimum hourly pay should meet area required, or employees should make up the difference. Absolutely right. Absolutely right. Good comments, good question. So another thing to think about, and you think about the question of stagflation is do I have to worry about this? Not immediately. Right now, this looks like a very robust job market. And one of the reasons that we look at that, how confident are people in the job market? And I know this is very relative and it's dependent on your sector, your experience and those things. I don't pretend, I will not speak for everyone. But in this case, in aggregate, we have the highest quit rate, the amount of people who are voluntarily quitting their jobs than we've ever seen since we started keeping track of this for the last 20 years or so. And roughly, for instance, in any given month, December as well as November, about 3% of employees left their jobs. Now, on the other hand, those of us who have stayed or something else, you end up in just hours of hiring meetings. And, you just end up with these candidates and things, and it's so hard to hire people back, and you're losing qualified people. But at the same time, this is a sign of confidence. People are actually looking around and saying, if you're not going to pay me and you're not going to give me or treat me with respect and decently, I will find that somewhere else. And they are. And layoffs are down, quits are up, hires are also still fairly incredibly robust. And that's really, really interesting. Now, quit rates, again about quit rates, because I just, people voluntarily quitting your jobs, we've all thought about it. Some of you may be here on Albert's list because you did that. You put down the resignation papers and said, you rock and rolled it. And in this case, this market right now is the most robust rate, but this is different. The rates that we're seeing, the highest quit rates, are actually the sectors that are also in the most need of employment. So leisure and hospitality, et cetera. And this happens when we have a large amount of demand. When we have a large demand for workers that can't be met, employers can either respond with employers have to respond with higher salaries and wages. And what we're seeing is that some firms who don't respond quickly or ably enough to that demand, those workers sort of move from that sector into either another sector or another business in that sector that pays them better. And so people are exploring, it's a sign of a robust job market. Now, the other thing is wages. So wages are really important here. And across the United States, this is the average hourly wages of production and non-supervisory employees. So if I looked at, and we talked about this earlier a few months ago, we were looking at the wage growth during the recession. What happened in the recession was that we had supervisory employees continue as usual, right? They took on, people quit below them and they kept increasing their wages. Non-supervisory employees saw their wages in the middle of the recession, stagnate. Like in March, April, May, hourly wages for non-supervisory employees were flat. And then finally, they were boosted up as the economy jump-started into recovery because they laid off a whole bunch of workers. And if you're a worker, you don't wait around by the phone for your old employer to call you. You go find a job because you have to pay for your apartment and your kids and your living expenses and all those things. And so you end up in a situation with where these workers left these sectors. And now suddenly you have this dearth of experience and you have to fill that. And the way that you fill that is by offering higher wages. In wage growth, and I want to point out here, the red line is I'm kind of doing, this is the slope most recently in 2021 of wage growth that we've seen relative to the slope in general of wage growth across the economy. And what we're seeing is wages increase at such a robust clip month on month. This is about as high as we've seen it. And I will note this is usually symptomatic of very robust economic activity. And it's so unusual that at least since the 1960s, we can't even say we have a precedent to this. So on one hand, more power to the workers for getting higher wages, but on the other hand, it's still very uneven where those wages go. So here's the other thing as well. Right now, I quoted you at that 4.7% year-on-year wage growth. Right now, this is the thing, that 4.7% includes January, February, March of 2021, disappointment canyon in our history of wage growth. So once this is, and wage growth is a backwards looking metric. So I look at the previous 12 months or trailing 12 months to compute my year-on-year wage growth. Wage growth is going to jump as soon as we go from April to April rather than December to the previous December, because we're going to drop those 3 months with disappointing wage growth. And so I expect this wage growth number will be very robust in the early part of the year, and that will further add fuel to the fire to the Fed to raise rates potentially in March. So let's look at this. So here's the other thing as well. We talk about hires and quit rates. So sector-wide, and I'm saying this, we start big before we go small, because the cool thing about the Bay Area is that it's a little bit predictive. So if I look at economic data that happens in the Bay Area in November, it's almost what the economy does in December for the rest of the country. So hires are greater than quits in all sectors. So meaning that more people are being hired than are quitting in all sectors, while lower wage sectors experience higher levels of quits and hires. So for instance, the hire rate and the quit rate is both high in accommodation and food services. The quit rate and hire rate are both low in financial activities. It's like the story of my life. It's like a kindergarten table where somebody's like, Reilly, what do you do? Well, I do financial activities. That's what I do. I don't want to quit. Nobody quits. Nobody quits. And on the other hand, this explains so much about finance. Why nobody quits. So construction, professional business services, retail, trader in the middle. Arts and entertainment shot out to me at the last couple interesting parts about this. And I come with this because, you know, I did some theater in college, and my friends that do professional theater and all these things, they run, you know, these one of my friends runs a sort of a theater company as a director. And one of the interesting parts is they have a really high hire rate and a really low quit rate. But unique to this sector, they also have a very high layoff rate. So what makes up for this difference? How are they hiring so much if they have so few people quitting relative to other sectors? And the short answer is they're also one of the few sectors that's laying off workers. And so if something doesn't make sense here, you can often make up for it with layoffs. I always find puzzles in statistics interesting. So here's the thing. So unemployment rate, 16 years and older. It is not universal, and it remains a little bit of a concern for the rest of the economy to see unemployment rate do particularly well for some individuals and less well for others. Black African-American unemployment rate actually went up in the last jobs report, whereas unemployment rate was stable or dropped for all the other three characteristics here. This is very interesting because it also shows that potentially, and this is also one of the sort of characteristics of the recovery, is how ultimately uneven it has been, and it's something to figure out. So the question is this going to continue like this? And I want something else, and this is interesting because this is going to bode heavily on the next year in terms of the jobs report. So I've shown you different charts that look like this one. This one comes from Glassdoor, but they all kind of say the same thing. It shows you how many jobs we lost, followed by the pace and recovery of the jobs. So the 2020 recession was the black line. And we lost tons of workers within a couple of weeks in the beginning part of the recession, followed by a very fast recovery. And right now we're up here. We're almost 2 years since the start of the recession. Isn't that amazing? It's amazing to think about that that's coming up in 2 months. Our anniversary of the recession. We'll have a cake. We'll have a special Albert's list. It will have like the ghost of Bing Crosby. He'll play it'll be great. One of the things, so 24 months after the recession start, we're almost at a level here. And here's the question: this trajectory going forward is an interesting question. And fundamentally, it's probably one of the most relevant for your job focused and job perspectives in your careers. If we go back to all the other recessions, it's very slow going. For instance, if we look at 2007, we didn't recover in the entirety of our job losses till over 6 years after after the recession began. And that was an incredible time period. But if I also look at this, and not only this, we had very low rates, but we also had, and interestingly, you can make up for some of this. Payroll growth will increase in response to increases in people coming back to work, but also increases in the size of the labor force itself, population growth. And I think an inhibitor to this is that we also have, and one of the important things to note, and I noted this earlier, is that we have in the last year, 2020 to 2021, partially caused by the pandemic, but also caused by lower immigration and a low rate of natural increase. We had the slowest population growth that we've seen since the Great Depression in the last year, about 0.1%. We only added a little bit more than 300,000 people to the United States last year. That's 1/10 of 1%. So in the course of a 10-year period, that puts you a little bit above 1%. And that is incredibly slow. But the terrible news, the other side of that is that's also due to COVID. But on the other side of this, we also have real demographic challenges. Other recessions can get back to these levels, and sort of the deceitful part about graphs like this, we can get back there by just bringing in more workers. Like we could lock and roll. I'll bring in 5 million workers, bam, we're right above that line. Everybody wins. Look, the graph looks great. On the other hand, if nobody wants to work here, or we put limitations on the amount of work, or we don't have population growth or something else, or nobody's entering the labor force, this becomes trickier. And so now we're looking at, and I had hoped for a steeper slope. I suspect this slope will be less steep. I think low population growth in other aspects, since most of the people who left the labor force are probably not coming back in the same way, this might take a bit longer than we anticipated, and it might start looking more like some of these other recessions. And that is sort of a change to this. So Albert says, I wonder how much technology plays into this. Cloud computing means more business agility and fewer operations costs. True. Companies fire quicker, but then they pivot. They could hire back faster too. But that's me thinking out loud. You're true. And we do see some relationship to that. We see sectors or cities in particular in the country that have a lot of firms, larger companies that do have agile ability to hire and fire large amounts of workers. We see those areas get hit harder during recessions with greater unemployment rate declines, followed by but also faster increases as they rehire. So that is true to a certain extent. And it's nothing to be like Malthusian about and be like, well, as companies agile, they're going to get rid of this. And we're always like, there's going to be technology and it's going to take us over. Usually at this time, we will continually create jobs and look at those. We're in an interesting situation where we have an aggregate number of jobs in certain sectors that cannot be filled because we don't have workers who wish to do those jobs, and we don't pay those workers enough money. And so because of those things, what are the answers to those problems? And there's also another thing as well. And the other things, we've had a very restrictive trade policy across the country, and I'm not advocating necessarily, nor am I saying, in the 90s, everyone was like, free trade is great. And it is great, but it's also uneven and it also contributes to inequality. But the other end of this, tariffs are also really bad. And there's a stack of papers this high to show why tariffs are not a good thing. They raise input prices for other companies. So even if you save jobs in one sector, tariffs lay off a whole bunch of workers in another sector. And literally just go to Google Scholar and look up tariffs. And you'll find everything you need to know about this particular thing. And we've had a restrictionist trade policy in both the last presidential administration as well as the current presidential administration. So the hard part is we're not doing ourselves any favors in this category, and the workers that we need aren't here. And so the question is how do we do that? And it could be a matter of immigration reform. It could be also ways to encourage people to provide, say, the ability. It is very hard. I'm not advocating we have one child here at home. That is enough, one and done. But if you're advocating for additional kids or less kids or fewer kids or more kids, whatever floats your boat, it is very expensive to have children. It's also very hard to have children. So the economics behind it, especially the lack of resources for parents, is very profound. And so we don't have a lot of things going for us for increasing our population growth to get us back to levels that increase our dynamism for our economy. So there are some prescriptions that are out there that could help this. Obviously, targeting immigration and bringing in more people, as well as encouraging enough safety nets to encourage people to feel comfortable and confident enough to have families, would be a step. But that also comes with a lot of downsides, and there's not a lot of, and that's the other side of this, and that's a whole other discussion worth having. But that also that requires political will and wherewithal, and people are very uncertain about all those things for very good reasons, and it's a very challenging thing. So without those things happening, we're going to see a steady a slower growth up this as we approach the next year or two, and I would be surprised if we hit this benchmark within a year. I'd be really surprised. I think it's going to be a little bit, it's going to be longer. All right. Bay Area. All right. I hope are you still with me?
Yeah, I'm here. There's a lot.
No, Christine's like, no, people are like, no, they all left. Everybody left. One of those things. It's just,
my main takeaway was now is the best time to pivot because all companies are struggling to get workers. Is that correct?
Yes and no. So the good news is some companies are struggling to get workers. The thing is, in Albert's list, we've got a lot of people here in the information sector. Information sector has been a little disappointing, I have to say. And that's not to say I sound like, that's what, if my mother wrote a biography about me, that's what it would be. Mainly disappointing. Information, we're up about 1,000 jobs. And so here's a side note on this. So November jobs report. So the Bureau of Labor Statistics releases December for the country, and then they go down into the Bay Area, and individual metropolitan areas are usually a month delayed. So we won't have December data for a little bit later. Ooh, dynamism. In what capacity? Can you quote me, Scott, in a sentence or less? So are we talking in the terms of growth or the ability to? So without population growth, the economy lacks dynamism. That's true. So the ability for workers to choose, train, and have a diverse pool of workers to handle a diverse set of tasks and skill sets is important for, it helps streamline the process of economic growth and firm expansion. So firms need a reliable labor force, and that labor force has to be itself varied. So one of the sick parts, for instance, if you don't have a dynamic labor force, or let's say that you live in a very expensive city and people who would normally fulfill service sector jobs can't afford to live there, so they move to other places, then you have a weird sort of upside down relationship. You have a lot of very high paid workers and a very and kind of a basis, and very few service sector workers or low paid workers because they can't physically afford to live in a certain place. And that makes it challenging for firms to hire, recruit, and develop things like infrastructure, build buildings. It increases costs and expansion. And so when you talk about dynamism, we're talking about the ability to not only have a workforce with a diverse set of skills, but also have resources available to expand firms in a meaningful way fairly quickly. And that was that's my definition. Thank you for asking for the clarification, Scott. Dynamism, dynamite. Boom goes to time. So the thing is that's why, you're looking for things, and can I fulfill all the workers in my pool? All right, so Bay Area runs about a month behind, as well. Any metropolitan area runs a month behind the national statistics, but some notes here. So we looked at this. If I look at this jobs report and I look at the U.S. jobs report in December, I see some things that reminds me of the U.S. jobs report. But here's the good news. So the Bay Area it increased the civilian labor force to the highest level we've seen since before the pandemic. About 2.5 million workers of working age are out there in the labor force, either having jobs or looking for jobs. Between October and November, there were 15,500, I should say, fewer unemployed unemployed workers in the Bay Area. And so not only did labor force expand, but unemployment dropped. So there's only about 95,000 out of the 2.5 million, which equates to about a 3.8% workforce. That's a good question. We'll talk about that, Albert. So one of those things, Albert says, with all these companies departing, jobs continue to be created. Yes, they do. And they may not be the same jobs. And I'll show you what was surprising in this. So where did we see jobs in the Bay Area? And this is good news. So we have a supply chain crisis. And in response, the sector in demand is trade, transportation, and utilities. There was an 8,000 worker jump in the Bay Area between October and November in that sector. That is a supply chain issue. So this is temporal. We're going to see that increase, and hopefully it will be maintained, but I'm not looking at this. I'm assuming agility, always assume agility regarding dynamism. Yes. Did the dynamism thing, was it contentious on dynamism? I hope I didn't offend anyone. I'm just arguing, I'm just looking for, put your CEO hats on and imagine you're developing a workforce of 1,000 people. And you're going to need some people to do certain jobs and some people to do other certain jobs. And having an access to an ability to have people across the spectrum is very important. And agility to respond, of course, to the changing economic needs is utterly critical, Linda. And I won't disagree. I have no disagreement. So in this, we have 8,000 extra trade, transportation, utilities jobs in response to sort of this fascinating retraction we've had across the country regarding our supply chains. An international supply chain just in time built out principles where we realized at the pandemic how vulnerable our supply chains were. And still to this day, we struggle with these issues. So in response, we expect to see this. I was surprised it took this long, but we've seen steady month-on-month increases since September in the Bay Area, looking at the expansion here. Food jobs are spiking. Yes, very good. And that's good too. Food jobs. So trade and transportation and utilities, absolutely. Professional and business services. These are higher paying service jobs ranging from everything from your business, your accountants, to your lawyers and everything else in between. That increased about 5,000 workers. And we also added about 2.7 thousand in education and health. Most of that was health. That's the other side of this. So the other side of this is we do see they loop education and health services together, but a lot of that is demand for health. And I'll actually show you why healthcare is particularly in demand in the Bay Area. If we look at the differential in wages relative to the country, we can actually look at and see which industries are in the most demand. So leisure and hospitality, to Albert's point, there's about 70,000 fewer employees in the Bay Area in leisure and hospitality now than there were prior to the pandemic, 70,000. The last month, they actually lost 400 jobs, which is typical in the winter months as you kind of go off season a little bit and there's tourists and travel restrictions and an increase in Omicron cases and those things. That happens. It is going to be interesting to see what happens. Ooh, Martha says, I think hospitality as it relates to large multi-day conferences will be interesting. That's true. And you're going to see a little hit certainly in winter as people say, well, maybe I should do this from home. And you're seeing that there. Ooh, yes, accounting and finance jobs exponentially. This is good. Marissa, with information on the ground, one of my recruiter partners has over 370 jobs open. Many require public accounting and CPAs. That is huge. And so financial activities, business services, often a lot of finance and accounting jobs are up here in the financial, professional and business services. And we're seeing expansion there. That's good news because the financial activities sector itself. So if we're looking at CFAs, wealth managers, other things like that, we're seeing very stagnant growth in the Bay Area around that question. But my hope is we'll see an increase in December based on Marissa's new information. I like it. I like it. This is where the word on the street comes together. Financial activities. Financial activities. Oh yeah, we only need accountants when it's tax time. Oh goodness. So anyway, so other services are up. So long story short, outlook based on a previous request into these things. So I'm watching information because information is tricky. Information is often the pulse of what people consider Silicon Valley, of course. And so looking at this question becomes very difficult. Growth has been slow, but it has not been departing. It is not negative growth, and it's not the worst sector that we're talking about. Trade is going to level off as supply chain issues get resolved. The expansion we've seen in professional and business services as well as financial activities is encouraging, because that means that corporations are looking towards planning and building towards next stage growth and development. Once those jobs are created, so once we add the right people to help build out our infrastructure, they continue potentially to expand in other sectors as well. I am concerned about information in particular, as well as leisure and hospitality. There's not a lot to say. The market, if anything, will be slightly more competitive next year, given the fact we have pressure on increasing rates. We're going to have a Fed that will be a little bit less free with money, and that'll raise input costs for new developments. And to give you a sense of this, when you think about right now, we are awash, relatively speaking, with private equity and venture capital opportunities, and not just talking about cruising down into the VC space alone, but the wealth of opportunities in entrepreneurial finance is out there. But all corporations and all businesses are sort of greased by the wheels of financing activities. And so if the rates that people are charging on these banks are charging, loans are charging, and then people expect to get from investments increases, this does kind of put a cap on that development. And that's going to be an interesting section. So there are headwinds in the information that we have to watch for the next year. And I wouldn't be, so I'm looking at slower growth there, relatively slow growth in education, continued demand for health services, leisure and hospitality. I'm hoping for an additional bump. I think you'll see kind of that spring and summer wedge next year. I'm not writing it off yet. It's taking a very long time, and the wage adjustment's taking a long time. And manufacturing jobs have been steady, and that's kind of where we're at. Yeah, and so labor force participation is still pretty good in the Bay Area. And if we look at, and this is interesting, one of the cool little tools you can do to figure out which sectors are in demand in a given time period. And this, unfortunately, is an old survey, but it's the most thorough. And it was done right in the middle of our recession in May 2020, or right at the concluding end of it. And if we survey wages across a given place, we can identify areas that are in the most need because they offer a greater premium than we would otherwise expect over a given wage. So we know that San Francisco is more expensive than other places. Just look at real estate or apartments or things or just stuff is more expensive. Now, the mean hourly wage in San Francisco in May 2020, to show you how much we've changed, the United States at that time was $27.07. San Francisco, and this is the metropolitan area, but somehow not San Jose, was $39.35. So you get a sense that's a 45% premium over the hourly wage in the US, due, of course, to higher living costs, et cetera, as you know. On the other side of this, which sectors are paid even better or worse than that number? And what's interesting about this is that even if you look at this in aggregate, a few sectors are in particular demand. They offer wages that are significantly or even above the premium in a very certain way that suggests that these sectors are in the most need of long-term employment. So even in the middle of the pandemic, we were still looking at healthcare practitioners in technical healthcare services. That offered a 46% premium in wage. Construction and extraction offered a 46 premium in wage. It's hard to get construction work in San Francisco for the costs in the rest of the country. Likewise, other parts of the economy that don't see wage increases relative to the rest of the country, architecture and engineering, you only get an 18% premium in San Francisco over the rest of the country. Farming, fishing, and forestry, 21%. Educational instruction in libraries, 21%. And so you have a series of situations, production, 20%. So this is often symptomatic. If companies can get away with paying less money, it's often due to an ability for companies to find a ready supply of lower wage workers, like immigrants, other people like that, or it has to do with the inability or the structural implications of the sector itself. What is the footnote 1% difference in table A? Oh, good. Scott, you're like my A student, Scott. I appreciate this. Reilly, what is that? I love it. I love it. Let me go grab that for you. That's a good question. Meanwhile, Colin, do you have any questions while I fetch that for Scott here?
I'm still looking. contemplating what's going on.
Yes, it's interesting, isn't it?
I guess my question would have been regarding the payroll growth from 2 slides ago.
Here's the
Does
figure.
time have any indication? Does time have any impact for the jobs market? Like the time to recover? Does the time, is there any impact on that time to recover? Because 2007 looked like it took a long time to recover. What outsized impact did that? It took what, 10 years?
Yes. Well, it took till 2014, till the beginning of 2015.
Okay,
from
so
late
7 years
2008.
to recover, which is a long time.
Yeah.
Does that have any outsized impact on the economy and jobs market as a whole?
Oh, that's a very good question. Okay, so
Compared
let's break
to
down
a
the
short
question.
recovery?
So we had $5 trillion of stimulus added across several packages in 2020 to help stimulate the economy. About 1/4 of our GDP, a level that we've never seen in previous years. That led to, and the interesting part is if we look at that question and we look at the acceleration of that, you know, how did certain sectors meet that? And that's complicated. So each recession offers an individual story because a firm's ability or a company or an industry's ability to respond to recession or stimulus is dependent on the nature of work. If you're heavily exposed to supply chain, that was a cost. If you had a lot of white collar workers who could work from home and use Zoom, then you could be flexible or agile in your way that you handled your experiences. If you, on the other hand, were in a situation where you relied on lower wage workers and say a restaurant or other things, you had to lay them off to get your bills, to pay your bills, you got your PPP loan, and then no one was there when you were ready to hire people back. You're struggling to find labor. And so stimulus is very difficult. And even anyway, if we have a big pile of money and we throw it at the wall, imagine that there's glue in certain areas where that money will stick and other places aren't prepared or able or willing to handle that type of money. Like we can throw money at something and it won't do well. And so I would actually argue in this case, yes, healthcare support. To Albert's point, actually, this is a good example here. Healthcare support is so important. Like it's hugely important, especially with the increasing supply like it's a commodity. Labor, the number of workers who are above the age of 55, retirees, other people in need of long-term care is growing and will continue to be substantial. And healthcare support workers are still paying this incredibly low amount. And it's also, and there was an article just fairly recently, like I just had it open, that looked at the sort of reliance of this particular industry on immigrants to help evaluate and sort of do much of this work. And so you have a lot of immigrants in this sector who are working these hours and extending it. You have a lot of people who are in more vulnerable communities. And the hard part is that, this is only going to be more expensive. And so the question is, there is a price at which anyone will do a job. And this is true for anyone, you sitting at home or someone else, even if it was, there's a price where I leave being a finance professor and assistant dean and go out and work at, one of the service sector jobs I did when I was in college. I was a janitor in college, and I had all these jobs. I was a baker, a candlestick maker, I had all these other things. But and I would go back to that if the wage was sufficient. And so wages and equilibrium are sticky and they don't always match supply and demand in a short amount of time. This is a good question. Okay, and the average of all occupations is 39.35, which comes out to just under 80K a year, which would qualify one for welfare. Yes, how can you live on that? And I see what you mean by that. San Francisco's Chinatown is home to a lot of workers who work menial wages at restaurants to pay for passage too. Many restaurants have been hit by wage theft lawsuits over the years as a result. That's true. And I don't mean this from a perspective is that we should rely on immigrant labor for unethical business practices, but I think we should, but we do often overlook the importance of certain sectors of the economy with that regard. And our ability, regardless of, and this is purely apolitical, but the addition of additional workers who are willing to work a certain wage that is below what sort of the equilibrium wage of an area will be, does enable, it has a lot of positive effects and positive economic effects over the long run. And we see these wages come up generationally and other things. And And that is also a factor in what I would call dynamism. This is really good. Good. What else do you have? Other reactions or questions about this? And so we would look at the wage question and be like, well, if you're paying a premium in particular for a particular wage that's even a bigger premium than you would expect, it means that they're trying to attract workers that would otherwise not exist there. And likewise, if a place has fewer workers, it means they have a supply of workers or at least sufficient capital to do this. And if we were to look at this again in May 2020, we were to look at this in May 2022, what would change? And if this followed even aggregate national numbers, we would see vast increases in our leisure and hospitality, our healthcare support, and food preparation wages in response to this. So not vast enough, but vast relative to their previous increases in previous years. And if we look at wage growth for leisure and hospitality in particular, that hit double digits last year. And that's encouraging, but it's still not enough to live in San Francisco. Marissa says, good questions. Yes, I agree with you. A recruiting colleague is 100 RN jobs cannot be filled with low wages. Some are pitiful. This is really interesting. So Marissa, would you argue then on the question? So I agree with you that the hard part is if you want people to be employed and to stay for a long run, you need to raise wages. But so do you find that there's reluctance in healthcare on raising wages for things like RNs? Or the economics don't work? And I'll let you, it's an open question. You can, and we would expect so. And so companies will try, and there is stickiness there. So on the other side of this, and my question goes out to Marissa and everyone. On the other side of this, think about where we're seeing difficulty keeping people and where we're seeing higher than average quit rates. And one thing that stood out in some parts of the country with regards to data has been government jobs. It's been hard to recover government work and recovering that. And one of the larger cities in the state here that I work with and consult with, they have 1/4 of their positions are unfilled. So 1/4 of their positions are unfilled. They're looking for workers. The hard part is municipalities have a harder time than private sector companies at adjusting to labor force demands. And so public workers, other things are often structured, sometimes by legislature to raise wages. There's other factors, other negotiation elements at play that make it difficult to raise labor wages to a higher level. And so people often leave government work for the private sector. And consequently, it's very hard to hire people back because the wages are so low. The promise of sort of a pension and a long-term benefit doesn't carry the same weight as it did some years ago. Margins are too tight. Oh, Marissa, thank you for answering. Margins are too tight given the cost of healthcare. Also, many hospitals have lost clinical workers and related as they require vaccination. Very good points as well. Very good points. So anyway, today's pension is the 401k, IRA, and if you like the danger, Bitcoin. Albert, this is why Albert's one of my favorite people. But yes, IRA, if you like the danger, yes, I don't have a pension. I'm invested wholly in Bitcoin for the future. I mean, please always diversify your assets. Finance rule number 2. And this is interesting about IRA. So 401k, the research on it is pretty good. They actually say that the average 401k worker ends up with slightly more money than they would have if in a present value way than a pension. But the problem is that we have this stack of behavioral finance research that suggests that people often don't always make the right choices in response to a 401k. So 40 years ago, 401ks were made legal 40 years ago. And so that meant that 42 years ago, in fact. And that meant that the onus of making financial decisions about your retirement once was the product of a firm and their management and their financial advisors, and now it went on the individual. And so many workers often underinvest in their retirement. And even if you enter a company and there's a required 401k contribution, people will often be hesitant to raise that required rate to a higher level. And so just be conscious on that. So some advice on that regard is keep an eye out for your 401k plan and other things, and try to increase the benefits, relatively speaking, increase the amount that you put towards a 401k in the long run. And all right, Vikram says, are there effective prices incorporating this in occupational risks like healthcare insurance? with the exception of healthcare sector where many where utilization is throttled. Many of the most hit sectors like F&B are the ones where risks of working exceed the nominal wage. So I also agree. I agree with that too. And so you're asking Vikram. Vikram's making a very good point here. That one thing that we don't do a good job responding to is so we all make decisions about where we work, and there's multi-factors that help determine what we're willing to do for a certain wage, right? So does the work offer me opportunities for growth? Is the work safe? Am I encouraged or helped as an employee? What are the risks of working in a place, right? And what happened at the beginning of the pandemic? To Vikram's point, the risk level increased. And in finance, you are compensated for additional risk, and that's how that happens. So the question is, did firms acknowledge, recognize, and appreciate workers for their additional risk? And if you've seen healthcare workers in particular, most would agree that the answer is probably not. So the hard part is so that's Vikram, that's a really interesting question. And I like that question so much. I might even start some labor research into that question about the pricing risk with regards to employment and risk changes with regards to prices. I like that idea, Vikram. Let's co-author a paper on that. Bam, do it. Let's do it. Let's do live finance research. A-, good work. All right, California, let's talk about the migration. So you read this in the news in December. We had 2021 population data come out at the state level. And there's a couple articles that came out. One is that you looked at this and you picked it up and said, people are leaving California. What a surprise, you said. I love it, Vikram, I love it. So you said, what a surprise. And no one was actually surprised. But the thing is this is unique because we're gonna go back to the time. So we had data from February and March earlier this year, where we were looking at this and saying, well, at that time, the data that we had showed people were moving out of San Francisco, moving to the suburbs, and now it looks like the number of people leaving California for other states, about 367,000, still a relatively small number, but that's 1 out of every 100, one out of every 100 Californians. It's a sizable enough number that you have to beg the question, why did this happen?
1 out of every 1,000, I think.
What's that?
I think it's 1 out of every 1,000, not 100.
Whenever, yeah, 1 out 367,000. No, it should be 1 out of 100, right? 367 times 100 times 10 is 3.6 million times 100 is 36 million.
Oh, I was looking at the 0.1%.
That's right. No, I'm looking at the bottom one. Yeah, U.S. population, yes. Colin's also my auditor. He gets paid for this. Let's go to 6. Anyway, U.S. population. The U.S. population grew by only 392,000. Meanwhile, an almost equal number to this, and also coincidental number, and about 1% of California's population moved out of California last year. And here's the interesting part. So Albert said, we did our entire report webinar in Cal Exodus 2. Did your predictions change? And the answer is kind of maybe, it's dynamic as we see it. It's like this is the thing. I'll be the first to say, I did underestimate the amount of people who left the state of California in 2021, and it was sizable. If we look at this, there's another, this is not the same thing. This is a separate thing. This comes from UCLA. You can't read it at the bottom. It says, this is from the California Policy Lab and the University of California. Actually, it's not UCLA. It's the University of California Consumer Credit Panel. I'm sorry. I can't even read. The small print is so small. It's like an eye test for me. So when we do this, so we look at the exit rate by county. If you look at people who left, and this is the percentage change in the people that left versus previous years, like we knew this already. We knew that people were leaving the peninsula versus other places, but also we're seeing swaths of California, basically everywhere south of Oroville, which is in bright blue here. I'm trying to think of other things, like there's Sierra County, and there's a couple of things up here in this little blue county belt in Northern California that actually gained people at this time period, cheaper real estate, et cetera, all those other things. And I know the Oroville guy has been on the news quite a bit, but the rest of this, the rest of the state, generally speaking, they're losing more workers than they would normally have. And again, cost of living, other things. So let's think about this. Feet on the ground, what does it mean? Is it apocalypse? No. What does it mean for you? So is there a silver lining to this? Is always the ultimate question, because people are looking in the back of their head saying, when can I buy a building or house or a condo or anything? And that's what they want to know, because they're looking for it. If enough people leave,
things should get cheaper, right?
Can I buy a $200,000 condo in San Francisco? The answer is no, but wait. So are there benefits to population loss? So this is where I put, this is called lipstick on a pig. This is the last thing. So this is the hard part, is no, not usually, but wait. So in right here, of course, as you know, asset prices, and I'll zoom in for the cheap seats, are really expensive in the Bay Area. And let me just get rid of this, because this is, you should see this. This is important. So I made this much worse to read, but wait, here we go. So Zillow keeps track of these things. All right. So a couple of Bay Area counties randomly selected by series of things. And I'm sorry I ignored you. All the people in Sausalito are going, where's Marin County? Nope, they're not there. The rest of this is good. So San Francisco, 1.53 million average sale price. Alameda, about 1.3 million. Contra Costa, about 908,000. Santa Clara, about 1.5 million. Long story short is that this is very expensive. You knew this. You're looking outside at this. You're perhaps in a building. You're saying, how am I affording this? Now, on the other end of this equation, though, look at the last year and a half. So beginning of the pandemic, we had a surge of economic interest. Real estate price increased particularly fast in the outer Bay Area relative to the inner Bay Area by rate, but then they are leveling off. Now, part of this level off is seasonal. This is a seasonal leveling off that happens in winter because people buy less real estate in winter anywhere across the country. But this is still interesting to note, because this seasonal leveling off of real estate prices is more profound in certain areas. And in even some areas, we're seeing a slight wisp of a leveling off to the point of a decline. Now, real estate prices, the input prices for people getting, rates are low, things are there. This is still a robust economy. This is a little promising to suggest that it's leveling off. But in areas where we see population loss, we don't see typically, barring economic devastation, large drops in real estate prices. What we do see is slow growth. So draw your line on this. So imagine wages will increase, other things will increase, and eventually this becomes more affordable over time. And, oh, this is good. So more words from Marissa. So those who leave California, the chances of living are going to improve the chances of those living there getting a job. Also, I'm hard pressed to get many candidates outside of California to move to Northern California. Again, the living there hasn't yet, and it's really hard to get people to come in because the real estate is incredibly expensive. It's so hard. There's so many good universities there. I told you, I got a job. I was offered a job at a Bay Area university. Like, my dad's from San Francisco. Like, I want this. Like, my great grandfather had the first car repair shop in San Francisco in like late 1800s. And I'm like, I'd love to go back. There's no way. There's no professor. I can't do it. I have to live out here. It's only a 16-hour commute, but I can make it there. And it's so hard to get people to move in from out of state, and even for those reasons. March 2020, Albert says, remember what we said in March 2021, until Stanford decides to uproot its campus and move, we should be okay in the near term. Stanford, Chico, it's going to happen. Stanford and Red Bluff. Who knows? How far can they go? In this sense, and you're absolutely right. And there's also, to that point, there's also the question of zoning, other issues, building real estate to accommodate this. Those are optimistic. I think a lot of what I've seen recently in California legislation, other things that are passed or being discussed regarding the, say, building of multifamily properties on what were formerly single family lots, et cetera, that groundswell of the yes in my backyard over the no in my backyard is promising for the development of a more interesting real estate market. If you increase supply, that can have the effect of reducing or potentially increasing both the economic demand for particular for real estate across a number of levels, making it more affordable for certain citizens to live there. Supply. There's a dearth of supply in the Bay Area. But San Francisco, for instance, look at the slope of real estate price growth relative to other cities. And I brought the ones that are always in like the focus of like the news and saying, oh, another California company has headquartered themselves in Austin. Austin saw a rapid increase in 2021, and it was much steeper, relatively speaking, than the rate of increase in San Francisco. Yeah, you're looking at that saying the average price of a home in Austin is only $600,000, or in Dallas, it's $290,000. So you have a choice. Would you rather buy one San Francisco home or 5 or 6 Dallas ones? There's a little bit of a difference there, but there's other things as well. The weather, absolutely advantage. The weather is absolutely an advantage to being in California, 100%. Closer flights to manufacturing hubs in Asia, absolutely. And that's always, and the bastion of Asian American trade is always going to be the Bay Area for that reason. And it's going to be fantastic. And I think that people are very myopically focused on this short run. In the long run, Bay Area trade dynamics, especially looking at this, are key. Yes, Texas property taxes are higher than California. $400,000 home in Austin is the same tax as buying a 1.5 California home. Yet at the same time, think about your aggregate bills. It's not always the rates, it's the levels. So in this case, yes, your property taxes will be more, but can you afford to live? And are you living with a group of 80? Yes, me, myself and my 13 favorite engineering friends have to share a place. At some point, we'll happily trade Mediterranean weather for sweltering summers and tornado risks. There's a trade-off there for everyone. No one wants to leave a place. There's actually a whole series of other dynamic research to show the actual impetus to get you to stand up and leave sort of a support system, a network, and the things of what you know are very difficult. That friction is always going to be there, and that's not going to turn into this. And San Francisco isn't and by that I mean the Bay Area isn't the same. And you know this as an industrial center like Cleveland or Pittsburgh or other places that had a series of economic doldrums followed by, partial resurgences, other things that have gotten a little bit better. Real estate is more expensive, but at the same time, like this is where still relative to Austin, even the most entrepreneurial firms are created, established, and developed. And I think that is going to continue to power this. And the Bay Area does have limitations. It doesn't have room to expand, it doesn't have land, it doesn't have things. And so then you have to decide whether you want to increase zoning density or whether you don't want to. And if you increase zoning density, you can actually stand a chance at reducing some of these real estate prices. Otherwise, you're going to see at least a little bit of leveling off, but it won't drop to nothing. I mean, yeah, if you get more land, maybe even acreage. Acreage, what's an acre of land is an incredible thing. Oh my God, that'd be great. Anyway, the dreams. No, this is not the move to Texas story. This is to say that patience and time in the long run, if it's unlikely, barring a real estate specific crisis, that this will drop in price significantly. Expansion of number of units or just the same thing we've seen for a while, followed by slow expansion. If wages can get back to a point where they outpace real estate growth, that would be an interesting phenomenon. Right now, still, despite this, San Francisco year on year had increased prices within the city of 9.1%. That still outstrips wages as well as outstrips inflation. So real estate is slower growing in the area, in the Bay Area, but it's still faster than it should be. Danny, thank you so much. Yes, I'm going to email these slides to Albert and he can disseminate them. All right, cool. Thank you. All right, I went long. It's 7:23, 6:23, 5:23, 6:23. I got optimistic. It's food time. Anyone have any questions? What else didn't I answer? Any questions you have? Anything that I missed? Or if you wrote it in the chat, you can write it again. I won't be offended if I missed it.
Yeah, everybody, if you have any questions, feel free to drop in the chat, drop in the Q&A, we'll address them. But overall, thank you for that wonderful presentation, Dr. White. This was very insightful, very full of interesting things to consider. I'm worried about the recession. I
scared you off with the yield curves, didn't I?
I was, yeah. It has 100% chance of prediction. It's never been wrong.
Thank you, Christine, so much. Thank you, Albert. Yeah, Albert, 100. Yeah, there's gonna be increasing. Thank you so much. You guys are so great. Thank you. What a great audience. Like genuinely, I'm always, anytime somebody listens to me speak, I'm surprised. So I'm genuinely honored. Joanna, yes. Joanna has a good question. Would you please help me understand what the Fed do, which led to tech stocks to drop so much recently? Yes. So tech stocks in general, of course, apart maybe because you work for a company that offers you certain employee stock plans, maybe you have options, other things to deal with tech stocks. It has been an interesting ride the last month, hasn't it been? Because when there's speculation, and this is the really interesting part about this. So and let me go back to one of my favorite slides here. Oh, thank you so much, Scott. I really do appreciate the kind words from Linda. Scott, thank you so much. I am so genuinely honored. So let me go back and I'm going to show you something that goes to Joanna's question here about the Shiller PE ratio. Let's talk about this. So why does, when the Fed do anything, why do tech stocks move so quickly? Like when the Fed says we might raise rates at some point in the future, and then tech stocks go no, and they drop 20%. This is why. So I'm going to show you this chart here. This is the price earnings ratio. You've seen it before, but there's a reason behind all this, right? So this tells you what the price of a stock is divided by the earnings per share, how much money the stock actually makes. Growth companies like tech companies, have really high price to earnings ratios. So that means that the prices are really high because they're pricing in all the future profits they're going to make. And that's why they command such high prices. So investors expect that they'll eventually grow to a level where their price to earnings ratio is justified. So in the long run, since 1880, price to earnings ratios across the economy have been about 20 on average. Right now, they're about the second highest they've ever been, around 39 or so, which is about double the amount that we'd normally expect. But again, this is also due to Fed policy. When the Fed lowers rates or keeps rates very low, it doesn't incentivize people to save money. It incentivizes people to take on additional risk to earn additional return. And where they get that return are things like the stock market. And the stock market, on average, returns about 11% if we go back from 1926 until today. Some years you do really well. We did better than that this year, or 2021, I should say. Some years you lose 46%, like in 2008, or leading into 2009. And it's very variable, and there's a lot of risk, but the price goes up and it goes down. Now, on the other end of this, so the Federal Reserve is really important for our stock market, because when the Fed raises rates, they're incentivizing people to not throw money at stocks, to put money in other places like bonds or savings instruments or accounts that actually earn more than 0% interest. And so the stocks respond negatively to these announcements, because not only from the practical perspective of, oh, this increases my cost of capital and it's going to be more expensive for these startup companies to raise money, but also people will shift their money from riskier bets to less risky bets if they choose to. A good example of this is 1980, look at the 1970s to 1980s. In this area, we had a really low price to earnings ratio. Nobody wanted to invest in the market. Why? Because they could earn 14% buying a government bond. If I can earn 14% in a government bond because of very high inflation rates, high interest rates, and consequently, stagflation, why would I invest in the market? I don't want to. Why would I try to earn 5% more in the market if I'm earning 14% in a given guaranteed bond versus investing in the market, which is much more speculative? And so when the Fed says they're going to raise rates, the market's saying, people will take money out of us and put it somewhere else. And it also, in the long run, there's the fundamental finance aspect, which is that, yes, it reduces and increases the cost of capital. The discount rate goes up for all these firms, which means that if we discount all those cash flows back to present day, that means that it's a lower number than it would be otherwise, because the discount rate is higher. And so prices go down. So it's a two-pronged thing, Joanna. Good question. Okay. I'll stop.
Any other questions? That was great. Didn't expect to get stock advice or predictions.
No advice. No, this is merely, I'm not a registered investment advisor at this time. This is merely, I'm just a finance faculty member. That's good. Anyway, thank you, Colin.
All right. Thank you, everyone, for joining us until this late time. Thank you for attending tonight's webinar. We hope that with this information, you feel comfortable job hopping or demanding a higher wage from your employer to beat inflation. We have numerous other events. I have dropped the link in the chat below, and feel free to sign up for them, and we'll see you there. In the meantime, have a wonderful 2022, and we hope that this year is better than last. Thank you, everybody. Let me